Well, good morning. We're taking a look at our ag commodity trade from the grain perspective first, and we're going to welcome aboard a very special, as Tim said, a VIP guest. Right beside me, right over here, we have Mr. Chris Swift of Swift Trading. He's based here in Nashville. Always good to have you on board.
Good morning. Always a pleasure to be here,
Welcome.
sir. Thank you.
Well, let's take a look at our grain trade. Let's go to the corn board here first. And as we look at the big screen, you know, this is a market with no sense of direction here, Chris. We're just meandering around. Can't really decide which way it wants to go. We have December corn a half-cent higher. We're at 6.77 1/4, and March is down 1/4 cent. It's at 6.81 1/4 right now. So just, we'll call it flat. How's that? November soybeans. Well, they're managing to gain about 3 cents right now at 14.28 3/4. The range, last night we got as high as 14.33 3/4, and we had a low of 14.11, so a 22-cent range. And right now we're about 18 cents off of the earlier low. Okay, let's check out what's going on in wheat. We'll start in Chicago. And we have December wheat a nickel lower at 8.75 1/2 here this morning. Meanwhile, in Kansas City, the hard red winter wheat, December down 2 3/4. We're at 9.47 3/4, so not a lot going on. Spring wheat trade in Minneapolis, December at 9.53 1/4 is up 4 cents, and it had been about 17 cents lower than where we are right now, so it's interesting. Now we're within about 6 cents of our high. So let's talk about this for a little bit. What are you hearing from producers around the country and other folks about potential for the corn and soybean market to hold their own as we get into harvest? Do you think we're going to have a temporary sag or not?
I kind of doubt it. The pace is really good this year. You've seen perfect weather for harvest, and generally now that we have combines that can produce the yield right off as we're harvesting, they can go in, they can look and say, hey, we're a little bit behind last year, maybe a little bit equal to, and that gives them some marketing opportunity. If they see they're coming in really behind, they're not going to be as quick to call the elevator and say, hey, I've got a truckload of corn coming in. They might as well store it. So I think what we're looking for going forward here is just the improved weather on there and some lower yields in the corn market, and probably about status quo yields on the beans. We're still a little ways from harvesting beans yet.
I've heard several reports where people go into the field and they figure it's going to be really wet. Mm-hmm. They say it's usually a few points drier than what they expected, probably on account of the late season heat here.
Sure, absolutely, and that's going to help because of the high natural gas and propane prices too.
You bet.
That's a big deal when you got to dry that corn down. If you don't have to and let Mother Nature do it, that's a significant expense that you don't have to fool with.
Now, what if the rail unions don't ratify that deal? How much would that upset the apple cart on the grain?
I think it would be pretty serious. We all got our hair on the back of our neck raised up last week or 2 weeks ago when it was happening. We were right in the middle of it, and there was a lot of talk. What are we going to do? Mm-hmm. And in all honesty, there was nothing you can do. You just can't truck that much corn around the country. It takes the rail to be able to do it. So I would dare to say that there are some people out there that have taken some precautions. They might have had in a little bit more grain brought in to help, but a lot of those places go just in time. Just about the time they run out of one product, the next rail car is coming in with it.
Are you a fan of wheat right now? I mean, do you think it's found support? Is it at a low or not?
Well, it's got two different things pulling on it. It has a very poor U.S. Drought condition here for our new wheat seedings coming in the ground. But yeah, we still have the European conflict and Russia with a lot of wheat on there that might have a tendency to try to sell it underneath everybody else.
Well, that's true. Yeah, and they have theirs and
yeah, it's a little tough to try to work the wheat there.
Yeah, well, okay, it all depends on who actually owns it. Okay, that's another story for another time. We'll come back in a moment, and then we'll talk about the latest in our livestock trade right after this. Well, now let's talk with Chris Swift about the latest in our livestock trade. First of all, I want to get your comment on the cattle on feed report that came out last Friday. I was a little bit heavy on the placement number, but did that surprise you much?
Not really, because of the drought. The drought to just keep moving more and more light cattle into the feed yards. And it's a very interesting situation how we are continuing to be able to keep as many cattle on feed as we are, a little bit over 11.2, but we know that we're robbing the back end of inventory. The cow slaughter has been very, very elevated as of recent. The heifer placement has been huge. So we know that we're really doing some damage to the back end, but there's nothing we can do about it. Well, the drought is moving cattle, and we wish that we could have expanded this summer, but we don't have the hay production to be able to do such. So we're all pretty much in the same boat, just having to deal with the weather right now.
That's why the marketing number is so high?
I think so. It's just getting rid of them.
How does that compare, do you think, to several years ago when we had such a terrible drought in the Southern Plains back then? Do you know?
Well, there's a big difference. The biggest difference is the money flow. Back then, the money flow was all coming in from the quantitative easings, and now the money flow is going out with quantitative tightenings. And so it's a big difference when you already have inflationary pressures there, and now you're going to increase the price of money. We know that we are losing land and producers out there at a pretty big pace out there. So when it gets time to expand again, I don't think we'll be able to produce as much as what we did before. And we look at Australia still to this day about 20% behind what they were this time pre-drought conditions.
Do you think, by and large, the outside investor pool of money has kind of withdrawn for now? Or not?
They haven't withdrawn, but they haven't added any more to it. It's
Okay.
kind of tough because everything, when you look at it from the aspect of margins, nobody's making margins. So you can really look at the price of things and go, well, that higher price is not going to help margins too awful much because all of our other input costs are higher as well. We know that our retail meat prices are relatively high. That's starting to work on the consumer. Restaurants are kind of busy right now because of lack of employment, so that's kind of hurting a little bit as well.
Okay, putting people on edge, that's for sure.
Yeah.
Let's take a look at our current prices on live cattle. Our quotes are provided by bar chart here, and we are higher across the board, led by the nearby contracts. October live cattle up 87 cents now, and you have December, which I understand, Chris, is where most of the volume is now.
Yes.
December 77 higher at 149.32 as it stands at the moment. Let's move on to feeder cattle here, and well, right now you have October 90 cents higher at 179.25, and November up 85 at 179.10. Also on the lean hog market, right now you have the October down 32 cents. And you have December down 37 cents. We're at 82.42. So actually kind of quiet, just a little bit easy on the lean hog side. Well, thanks so much for joining us.
Always a pleasure, Marlin.
Always a treat to have you come
Yes,
in.
sir.
I look forward to it. All right, Chris Swift with us. He's with Swift Trading, and he is based right here in Nashville. With that, Janet, I will turn it back to you.